Good morning, everyone, and welcome to the American Enterprise Institute. We're spanning the globe from many locations. I'm coming from cell block 5, but you can't beat the commute. Today's event is individualizing the market. Let me get here. Just a second. Sorry about that. Okay. This is the joys of always having these things operate quickly. Sorry about that. This is always, it always works more perfectly in real life than it does there. Okay, we should be set now. No, we're not. Well, that always seemed like a good idea at the time. I know what I'm doing, even though it doesn't always appear like it does. Nope. All right, looks like we're going to have to do some repairs. The original title was Individualizing the Market, Subsidies and Regulation, more or less. I thought I'd get mathematical and we'd do the plus and minus sign. So it looks much more actuarially perfect. I'm Tom Miller, Senior Fellow at the American Enterprise Institute. I should point out that I've been at this for a long time. This is actually the original slide, a copy of it, from a health affairs conference in fall of 2002, nearly 19 years ago, when they took a look at the individual market. Not much has changed, just the arguments somewhat mutate a little bit over time, and we've made just as much progress as we did back then. Now, in addition to that, what I said at the time was the individual market, it gets no respect at all. And that continues into the current. Perhaps it's changing to some degree as we're seeing this in a somewhat different light. There's some evolving state of the health insurance markets. Our speakers will have more detail on this. But roughly speaking, enrollment has been growing, but not a lot over the last couple of years after it had hit a peak, I think, in 2015. Many of us take a look at the and there's imperfections in every measure of the market, whether you double count and what you include, what you don't when you're doing it. But many of us rely on the state filings through the NAIC, and Mark Farah Associates tends to do a good job on that. And that shows the general trends in the individual market creeping back up after taking a bit of a hit post 2015. Other parts of the market, the small group, fully insured market has been plummeting a good bit since the Affordable Care Act went into effect. Multiple reasons, including some recent job losses in the pandemic, but that's down about 40% by some counts since 2013. And some of that got drained off into self-insurance as well as that market expanded. The large group market is stable, but not necessarily growing. I mean, things bounced around a little bit during the bungee jump recession, but it is basically about where it is, with not a big opportunity to expand further. The growth areas, of course, been in Medicaid, which has been on steroids and pumped up for multiple reasons, including some maintenance of effort. And you can't kick anybody off if you want more money type rules over the last couple of years. But we're, by some counts, getting over the 80 million mark. Now, some of that's in other parts of Medicaid, which was there before, but it's certainly been a growth opportunity. The question is, how much further can it grow? Medicare Advantage, another area of growth, more on the private sector side, competing a bit with traditional Medicare, which wants to get into the act by having some expanded benefits in order to get back part of that. And that's where we are on the enrollment front. Uninsurance has been moderately stable despite the wishes or hopes of some in either direction that it might have changed a lot during the pandemic. It's a lot of these numbers that are a little strange. Profitability, remarkably, profitability in the fully insured small group market is actually up. Even though they're insuring fewer people, they're making up their profits on less volume, apparently. But that's an interesting, and it's in some ways more profitable than the fully insured large group market. And then the profitability took a big hit in the individual market in 2015. It was about a billion loss, but it's been had 4 years of profitable growth since 2017. Some of that due to some changes in the way the subsidy structure works. So the growth opportunity, there's a little bit of a fight for market share after all is said and done between something that's a little more private and a little more public. Nobody's going to be fanatical about this type of stuff, but that's essentially what's going on. We've had more growth on the public side than the private side, but there's a lot of mixtures as to what you want to call public and private. And when you're looking for growth opportunities, if you're a private insurer, you've been mostly looking at Medicaid managed care and Medicare Advantage as your opportunities, because there's not much more give in the employer side of the market. The question is whether you might be able to find some new opportunities in a different type of expanded individual market. And again, there are blurs there with the subsidized ACA marketplace plans, which are both private and public, depending upon what day of the street you're describing it, or day of the week. So there's remedies and straddles on this, where depending upon what you want to achieve, sometimes for political reasons, sometimes for economic reasons, you can end up with different settings on the dial. Now, there's a lot of dispute, though, over the individual market. It's sort of like what the old saying about academic faculty meetings, that they're most vicious because they're such small stakes. The original source of this, it was attributed to Henry Kissinger, but it's actually a Columbia professor, I think is the general consensus view. Wallace Sayre, one of his laws of, I don't remember what the laws of, may have been attributed to this in the late 60s or 70s, but it's like many of these sayings, they have many fathers and mothers, but the debris is essentially what we can count on after these events go on. Now, I mentioned that kind of there's a lot of money up for opportunity. So with these subsidies around, what we've had is a little bit of a search for the golden fleece, if you will. Jason and the Argonauts going out exploring to come back with an extra pelt. And there's certainly some opportunities to gain, whether you're a public entrepreneur or a private entrepreneur, with more money seemingly on the table as it evolves down. Now, some of these payments are what I would call almost, in the old phrase, honest graft. In the George Washington Plunkett version, where you can find ways to find your opportunities to better make use of the public subsidies that are around. We had the silver loading, which was another form of somewhat re-engineering and wiring the market, where it ended up being more profitable for insurers. For those who are insured, some state regulators got a little bit of relief as well. And it's just the taxpayers, the only people making up the difference. This is actually starkly legal, despite it seeming like a bit of a kickback. Because after all, it's just someone else's money, and that's close enough. Now, we've also had, there's two different kind of approaches to this. One is to say, maybe we've gone too far. This is actually causing some side effects. You'll hear things about target inefficiency, how much it costs per newly insured. On the other hand, it's just business. So this is kind of the question as to whether or not we're moving into moving money in other directions. And the other proposal, as opposed to cutting down on the subsidies, is to actually make it rain with a little bit of helicopter money. It worked for 2 deep recessions. Why not fire up the rotors and drop some more down before we're out of the entire basket? So that is certainly the proposal, to subsidize more rather than subsidize less, depending upon which your targets are and what you're trying to accomplish. Now, this is a more complex graphic, which is another proposal, which is to try to, in effect, do a little bit of disintermediation in the old financial sense, which is to get some of the middlemen out of the health insurance market. In this case, it's probably the employers, and this is the proposals for different variations of health reimbursement arrangements, whereby having a funded account, you encourage the workers, sometimes push them a little bit to get into more individual market coverage or individual like coverage, and the employer in the middle, which is a little ambivalent. They don't necessarily like to be pulling all the freight, even though they're using as fuel the workers' wages, that they like to perhaps get cut out of it. So again, this is the complex graphic. I know it's hard to understand, but basically you cut out B in order to go from A to C. This is I wanted to get exotic on this and show the full effects on this. And there are different variations as to how to do the HRAs, which are some of our speakers will speak about again. A different way of thinking about doing this is to go back in older times from, say, the 60s and 70s. You won't, but I have an annotated version of this presentation, which is the old Johnny Carson Art Fern Tea Time movie, which he used to talk about going to the Santa Monica freeway till you came to the Slauson cutoff. And what do? You cut off your Slauson. Same thing in terms of the employer-based coverage. It's a very important concept and took a lot of time to work that out. Now, one of our speakers more enthusiastic about the expansion of HRAs, not only for the what are called the individual coverage HRAs, but also to use that as a vehicle to transform some of the large employers' self-insured market. We'll talk about a different approach to use the HRAs to, if you will, untie the Gordian knot. Many people ask, what's the Gordian knot? Well, this is a rather ambitious approach. It goes back to Alexander the Great in order to being able to conquer all of Asia, or at least the individual health insurance market. And so the question is, how do you actually untie the Gordian knot? There's a lot of dispute about this historically, whether Alexander just came up with a clever way to get through the multiple layers. There's other views that perhaps he took more of the Indiana Jones direct approach, not necessarily shooting a gun at the person with the sword, but just using a sword to slice right through the knife, the Gordian knot, and accomplish that there. Now, the other problem with kind of untying the Gordian knot is maybe you have to mythologize something that hasn't been seen before, a bit of a hybrid creature, which actually accomplishes that. This is what would be the chimera, which has not actually been seen in nature, but is a little bit of a clone of something between the employer and the individual market, a rather fearsome creature if you've ever encountered it, but we're still on the search for that along with several unicorns, but hope is on the way that could be accomplished on that front. All right, now the other part is we're going to talk a little bit about reinsurance. And the question is, reinsurance has had some gains thus far in terms of bringing down premiums. The question is, how low can you go in the limbo pole in terms of an attachment point? At some point, you may run out of new money to put into the market, and the distorted premiums that were easy prey originally may not be as available for bringing this down further. But again, we'll see what can be done on the reinsurance market as another magical solution around the side to re-engineer at least parts of this market. So that's where we are right now. I'm pretty much, this is the simplified, illustrated version. There's more complex thoughts coming from our scholars who will do the more elaborate heavy lifting, but I've done enough for here. We will have some questions which will come at the back end. You can submit them either by email, cameron.tarbell@aei.org, or on Twitter, if we haven't been banned by that point, at Ask AEI Health. And at this point, having exhausted the entertainment portion of our program, let me introduce our speakers. We have 3 speakers on our opening panel. I will pull that off there. I'll introduce sequentially and they'll speak 10 to 15 minutes apiece. We'll start with Peter Nelson, who's a senior policy fellow at the Center of the American Experience, based in Minnesota. And Peter focuses on many things, but particularly the intersection of state and national health policy, with a good focus on state waivers, used to be called 1332 state innovation waivers. We'll see where they stand as they're revamping a little bit of the regulatory environment for those as we've changed administrations and points of view on many aspects in health policy. And while Peter also has worked with health reimbursement arrangements, he's spent more than 3 years from late 2017 to early 2021. You weren't around on January 6th, I don't think, Peter, right? No, you are. But served as a senior administrator, senior advisor. He thought he was the administrator, but you're only the senior advisor to Seema Verma, who is the administrator at the Centers for Medicare and Medicaid Services, and dealt with a number of areas of change and proposals for change in health insurance market regulations and state innovation waivers. And Peter had a interesting piece up in the Health Affairs blog in August, which was a combined set of reforms, some of which he'll touch on in his presentation today, that could at least improve, alter, or somewhat adjust the individual market. We'll see where it goes from there. But Peter, go right ahead.
Well, thank you, Tom. It's a pleasure to be with you all today to discuss the future of the individual health insurance market. And before we get into what the future might hold, it's a good idea to review a little more history here and where we are today. So the number of people who buy health coverage through the individual health insurance market has never been very large. Just prior to implementation of the Affordable Care Act, the market numbered around 11 million people. That's less than 5% of people under age 65. Nonetheless, it's always been a very important market for people who don't have access to employer-sponsored coverage. Before the ACA passed in 2010, there was some rather broad interest in making the individual market work better. People on the left and the right all saw a broken market. Premiums were too expensive, it was too hard to shop, and insurers could deny coverage to people with pre-existing conditions. While the left saw a market more in terms of something that needed a government fix, many people on the right, myself included, had a bigger vision for the individual market. When running for president in 2008, John McCain proposed to ditch the tax preference for employer-sponsored insurance and instead provide Americans a fixed tax credit to buy the health plan of their choice. Likewise, in the debate over the ACA, leading proposals from Republicans in Congress recommended to shift the tax break directly to the individual. From the right, there was growing agreement that giving individuals and families control and ownership over their health plans would lead to better health plans. Instead of an employer or the government making this choice, millions of individuals shopping for their own health plan would spur a more dynamic and competitive health insurance market, driven to deliver more affordable, higher quality health plans. Of course, Republicans lost this debate. Instead, the ACA implemented a different set of policies to fix the individual market. The individual market provisions of the ACA focus mainly on improving the existing market as a way to cover more uninsured people and to guarantee coverage to people with pre-existing conditions. To address affordability, the ACA provided premium tax credit subsidies to help people shop. The ACA established health insurance exchanges, and to protect people with pre-existing conditions, the ACA required health insurers to guarantee coverage to everyone without charging sicker people higher premiums. Today, we're now in the 8th year of implementation of the ACA's individual market reforms. And it seems the left and the right still agree there are some problems with the market. Republicans have long argued that the ACA led to higher, unaffordable premiums for people who don't qualify for premium subsidies. It was a major talking point in their bid to repeal and replace the ACA in 2017. Democrats now clearly agree affordability is a problem. Earlier this year, Democrats in Congress took action to temporarily expand premium subsidies, and their $3.5 trillion spending bill would make this permanent. Go back to Tom's slide with the helicopter raining money. That's what we're talking about. And affordability is clearly an issue right now. Average premiums across the country jumped from $242 a month in 2013, the year before the full implementation of the ACA's market reforms. And that moved to $352 a month in 2014, just a year later. Premiums then rose to $588 on average in 2018. Older, moderate income Americans have been hit the hardest by this premium increase. In the highest cost quintile of counties in America, a 60-year-old who earns a bit too much to qualify for subsidies will have to pay 35% of their income for the lowest cost silver plan. Now that's the extreme, but when you look at the lowest quintile of counties, the lowest cost quintile of counties, 19% of income is what it's going to take to pay a premium for that 60-year-old. High unaffordable premiums have driven millions of unsubsidized people out of the market. And that's what this slide shows right here. This chart shows enrollment that changes across the entire individual market, including enrollment on and off exchange. Now, the on-exchange enrollment rose to about 9 million in 2015 and has remained remarkably steady ever since. However, each year since 2015 shows a substantial decline in unsubsidized off-exchange enrollment, leading from 17 million in total to 12.7 million enrollment in total in 2019. Now, some students of enrollment numbers will notice these are slightly smaller enrollment numbers than you might have seen in general CMS documents. This is December enrollment, which is why it's a little lower, and it's December enrollment because the 2014 and 2015 data for exchanges only include December enrollment. So if you can move on to the next slide. Higher premiums and the related decline in unsubsidized enrollment show just how the ACA failed to efficiently cover more people through the individual market. If the goal was to use the individual market to cover more people, then these coverage gains came at a very high cost. As the premiums went up, taxpayers spent more per person subsidized. At the same time, as premiums went up, unsubsidized people left the market. Ultimately, when you look at the federal cost to insure more people through the individual market, this combination of increasing premiums and declining enrollment has led to an enormous cost per extra person covered. This chart shows both the enrollment gain for the entire individual market and the federal cost per gain. The federal cost is limited to federal spending on just premium subsidies and cost sharing reduction payments. As you can see, the cost per enrollee gained increased from about $4,000 in 2015 at that height of enrollment to $20,000 in 2019. And this slide looks at total annual enrollment, so we're not exaggerating this number. Now, some might consider this an oversimplified efficiency metric, but I think each of these charts provide an important picture of the cost and enrollment trade-offs that resulted from the implementation of the ACA. So that's it for the slide. So if we want to take out the slides, we can remove the slides at this point. Thanks. Now, and I would say most people following the details were conscious of this trade-off at the time the ACA was passed. People knew premiums would rise. Actuaries certainly predicted premiums would go up by some measure. The individual mandate and the premium subsidies were projected to bring in healthier people and work to lower premiums. However, it was assumed that many other factors would, on net, lead to higher premiums. Now, I want to focus on one factor that likely increased premiums, but as far as I can tell, was entirely overlooked early on. And that is the ACA's premium subsidy structure. We know the government subsidies generally inflate the price of items subsidized. Look at the housing market and college tuition. While the subsidy itself can be expected to likewise inflate premiums, the structure of the ACA subsidy makes things worse. That's because the ACA subsidy is linked to the price of the premium. When the premium goes up, the subsidy goes up. They are tightly linked. As such, the government tends to pay the full price of a premium increase for the subsidized. This means there's little pressure on the insurers to control premium growth. Now, it wasn't until 2017 that any research came out to measure this impact. But in 2017, Mark Shepard and Sonia Jaffe used pre-ACA data from the Massachusetts market, a very similar market, and they estimated premiums were 6% higher in 2011 under a similar premium subsidy structure. They further simulated what the market would look like with fewer insurers and found up to 12% impact with just 2 insurers in the market. Due to differences between the current ACA market and the 2011 Massachusetts market, it's entirely likely that the inflationary impact of the ACA subsidy is even higher. That's because most ACA insurance markets are less competitive than Massachusetts at the time, and there's a much lower proportion of price-sensitive, unsubsidized people in the ACA market. Now, affordability isn't the only problem with the individual market. At the same time premiums were going up, the coverage offered by insurers has been growing skimpier with higher cost sharing and narrower provider networks. Here again, I think we have some agreement from the left to the right on this being a problem. But I want to note, I'm not suggesting that higher cost sharing or narrow networks are bad plans. They're just becoming the dominant plans and in some areas, the only option. A strong individual health insurance market should deliver more options. So if we all agree individual market premiums have become unaffordable and plan options are becoming too limited, then what should we do? Well, Democrats in Congress are currently proposing one solution. They propose to permanently expand premium subsidies. This would create free zero premium plans for people under 150% of the federal poverty level and extend subsidies to pay premiums that exceed 8.5% of income for anyone above 400% of the poverty level. Now, there's no question this will cover more people with more affordable coverage. Spend more taxpayer dollars on something and you will get more of it. But from my perspective, the trouble with this approach is that it basically builds on all the ACA policies that created this current dysfunction in the market. It's spending more taxpayer money to make premiums more affordable for some people without addressing the underlying cost drivers that have been making premiums more costly. In effect, this policy decision accepts the dysfunctional state of the current market as given that either politically can't be fixed or isn't worth fixing. Now, I still have some hope in a bigger vision for the individual market, a vision where a dynamic, competitive individual market becomes part of a longer-term solution to control the high and rising cost of care in America. So here's a few ideas to move toward that vision. First, we should shift from the current premium-linked subsidy structure to a fixed subsidy. The benefit to the current subsidy structure is that it provides very strong protection against any future premium spikes because the government automatically pays for those spikes. However, the big trade-off, major flaw I noted earlier is much weaker price competition, which inflates premiums. Now, if premiums were erratically jumping up and down, this sort of subsidy structure might make sense, but they're not. Even with COVID, the market has settled down from those early years, and so there's now little advantage to offering a subsidy that automatically inflates in step with premiums. A fixed subsidy offers a much better approach. Instead of giving insurance companies a blank check to increase premiums, a fixed subsidy gives them a target to help drive competition and innovation. There are many ways to design a fixed subsidy. It could be set large enough to replace the employer-sponsored tax preference and allow anyone to afford a basic health plan. Or it could be fixed at a smaller level within the current ACA structure and graduated by income to provide a higher subsidy for lower income people. The key is to remove the automatic inflator. Moving on, next we could establish a federal reinsurance program to help equalize the claims experience between the individual and group markets. This idea aims to account for the fact that individual market plans now attract higher risk individuals than group health plans due in part to the ACA's regulatory structure. While moving to a fixed subsidy would work to limit future premium increases, it would do nothing to address the immediate affordability issue. Reinsurance program, however, would immediately lower premiums. Reinsurance generally pays a portion of high-cost claims above a specified amount up to a cap, which in turn lowers premiums. A number of states have successfully implemented state reinsurance programs through state innovation waivers. For instance, Minnesota's reinsurance program pays 80% of claims above $50,000 up to a cap of $250,000. This lowered premiums by 21% this year. The federal program would operate similarly, but be limited to subsidize the individual market claims that exceed the group market. Importantly, because reinsurance pays only a portion of claims, insurers still have some incentives to control costs. Some might call this a bailout for insurers, but unsubsidized people in the individual insurance market should not be forced to bear the full burden of the ACA's costly regulations. And there is an upper limit that is tied to claims costs in the group market. This is not a blank check to insurance companies. Now, as a sidebar, it's worth noting here that the current congressional proposal to extend premium subsidies over 400% of FPL will almost certainly impact the future of state reinsurance programs. State reinsurance programs focused on lowering premiums for people above 400% who don't qualify for subsidies. But by extending premium subsidies to people above 400%, the Democrats' proposal entirely replaces the reinsurance benefit for a large number of people with incomes above 400%. Thus, there will be far fewer people who benefit from reinsurance, and the people who do benefit will have higher incomes. Nonetheless, there will still be some people who benefit, and it's really hard to say what's going to happen. It's hard to take a benefit away. So it's not clear what states will do. Though I would guess if this expansion happens, it will stop states from pursuing them in the future. Now, finally, for a last item to consider here, we should codify the health reimbursement arrangement rule in statute. When I was at CMS, we finalized a rule to allow employers to fund individual market premiums through HRAs with pre-tax dollars. Tax code has always included a strong preference for group coverage, and this rule helped put individual coverage on a more equal footing. If enough employers adopt HRAs, the individual market could grow much larger. Millions of new consumers using HRAs to buy individual coverage could be the sort of transformative change that drives real competition into the insurance markets. Putting this rule in statute would provide helpful clarity and confidence to employers considering the option. Unfortunately, like reinsurance, the Democrats' proposal to expand premium subsidies would likely impact the viability of HRAs. If this expansion happens and inflates premiums even higher, HRAs just won't work. So to sum up, I think most people can agree that 8 years into the implementation of the ACA, the individual health insurance market continues to have some problems, in particular on affordability. One clear option coming from Congress is to expand premium subsidies. This would certainly address the affordability issue for a large number of people who have been paying full price for high premiums. However, it would come at a great expense to taxpayers and the federal budget, and it would also accept the dysfunction that led to high premiums and likely relegate the market to remaining part of the cost problem and playing only a small role in the overall healthcare system. I've outlined a different approach that envisions a much larger role for the individual market. I believe a robust competitive market for individually owned and portable health insurance can be part of the solution to the high and rising cost of care in America. Importantly, it can happen without dismantling the ACA or undermining coverage for people with pre-existing conditions. From left to right, we've always agreed low-income people need subsidies. We need some reforms to the ACA's subsidies to minimize how it distorts the individual market. A fixed subsidy structure and reinsurance go a long way to get us there. And then we can let the market grow beyond the subsidized to compete to deliver better coverage for everyone else. Health reimbursement arrangements can be a key part of that expansion. Now, those are just a few ideas, and I know there's a lot more we need to consider. So really thank you for your time, and I'm looking forward to hearing from our next speakers on what we can do to make the market work better. Thanks.
Thank you very much, Peter. Our next speaker is Barak Richmond. Barak is Catherine Bartlett Professor of Law and Professor of Business Administration at both Duke Law School and the Duke Business School. He combines the dangers of both the PhD in economics and a law degree, but we won't hold that against him too much, and straddles the field from innovative approaches in healthcare policy, also antitrust and business institutional economics. Barak has also been collaborating a lot with Harvard Business School professor Regina Herzlinger on ways to recraft the potential of what you can do with HRAs, not only in the individual coverage side of the market, but also to dent the self-insured larger employer side of it, and perhaps provide some incentives and opportunities for employers to find somewhat more affordable and economical choices on that front. Barak?
Tom, thanks so much. Thanks for the introduction. Your introductions are always both generous and substantive while being succinct. So it's always a challenge to actually say something beyond what was in the introduction. So let me see if I can elaborate at least a little bit. So as a starter, I don't write about the individual market. Everything I know about the individual market, I've learned from Dave Anderson, who's on the next panel, and anything that I might try to write about the individual market would not exceed what Dave has already written about it. So you might say I know my place. I write about the employer-sponsored insurance market. Now, the reason I'm on this panel is because those two markets are two sides of the same coin. They are purchasing similar products. You're either in one or the other. Actually, Tom would probably say there's a third side to the coin. I mean, healthcare is complicated, right? There's a third side to the coin, which would be public insurance purchasers as well. But you know, the individual market is difficult in large part because it's always been a residual to the employed market. But also, the robustness of each market affects the other. So to the degree that they are intertwined and interconnected, certainly writing about the employer-sponsored insurance market is very important. And I might even say it's a little bit more important. That is, the employer-sponsored market is the dog that wags the tail of the individual market. And to the degree that we really want to think about improving the individual market, it might be very useful to think about improving the group market or the employer-sponsored market first. The second thing I'll say as an introductory remark is that what I say will dovetail very nicely with Peter's last recommendation about using HRAs or ICHRAs, individual coverage, health reimbursement accounts, what we call ICHRAs. It's the new acronym in healthcare. And you know, if there's one summary of what I'm going to say, it's that ICHRAs can be used to improve the employer-sponsored insurance market and thereby helping the individual market. That's the way I would see the progression of benefits. Although, even if Peter and I are in full agreement that he says that HRAs might help the individual market, I say that's an additional reason, but we both are in agreement that it could help. All right, so let me share my screen for only 3 slides. And this is what I would say my summary of the case. This is why I think that it's really important to look at the employer-sponsored insurance market, because it's really big. It's about 10 times the individual market. And most of the employer-sponsored market comes from large firms. Most of it comes from self-insured firms. And to the degree that you can incentivize the behavior of these large actors, you are really going to shape the market. And to the degree that you can incentivize the behavior in socially beneficial ways, you're going to improve the market in really beneficial ways. So to the degree that we can think about insurance markets writ large as multiple sides of the same coin, I think this might be the better approach to really thinking about the individual market, or at least how to improve the individual market. Now, there we go. Now, even though the insurer-sponsored market is so much larger, its premiums really have matched both the individual market and also the fully insured market, the small group market. And that's kind of surprising, because you would actually think that if so many individuals, so many economic institutions are relying on employer-sponsored insurance, there would be certain efficiencies associated with it. Now, look, this is measuring premiums; it's not measuring quality or expansiveness. But you know, if we want to think about our primary problem, what we call the cost conundrum, we can certainly see that employer-sponsored insurance is not doing what we really hoped it would do. And by the way, this is both pre-ACA and post-ACA. You see a very natural trend. And you know, this is, I think, attributable to things that are happening in the provider side, not in the insurance side. Consolidation, anti-competitive conduct, the expansion of bricks and mortar healthcare systems to control the whole marketplace, the stifling of innovation in large part because of the expansion of of large health systems. And therefore, if we think the cost conundrum mostly is driven by the provider side, we want to think about how we might be able to use the large purchasers of insurance to try to combat that. And the large purchasers thus far have not really done that. And this is this is my last slide, and this is another very nice illustration of what I think is the major cause of cost inflation. Now, Peter's main boogeyman are subsidies, and I'm not going to defend subsidies. Again, that's Dave Anderson's job if he wants to defend subsidies. That's not what I write about. But what I do see is that private insurance has done a really bad job of keeping down not only the cost of healthcare as it relates to Medicare, but also the quality. And we see this really eating into workers' earnings. We see that the cost of healthcare has been eating into, has been far exceeding inflation, far exceeding wage growth, and really is the primary policy challenge that we have today. So, all right, so what do I have? What are my slides summarizing? They're summarizing that we have a cost conundrum. It is a matter of the utmost importance, not just in health markets, but for economic growth, and also, frankly, for those who believe in wage equity. And the best way to start addressing these problems, I think, is through the large purchasers, the employer-sponsored market. And what one of the proposals that I've been working with, and this has mostly been, as Tom said, with my co-author and friend Regina Herzlinger at the Harvard Business School, we have thought about how we could bring more competition into the employer-sponsored market, not so much between employers, but within employers. One of the real problems, and there's a very interesting literature on this, but one of the real problems in the employer market is that the purchasers are neither adequately cost sensitive. I mean, health insurance is purchased through the HR department, not through the finance department. The HR department is concerned with worker culture, worker retention, worker recruitment. The finance department is worried about costs. So one problem we see in the employer-sponsored market is the lack of attention to cost, or really the lack of attention to value. And the other, I think, is the lack of attention to the diversity of needs in a large company. In particular, we see that the kinds of insurance plans that are offered to employees do not include a lot of choices. Most companies only offer one or two choices of health plans, And most companies have a significant diversity of employees, with lots of different economic needs, lots of different priorities, lots of different cost sensitivities. And what we see in large part, and this has been established through a literature that not only looks at what firms do, but also some really interesting insights into how firms operate internally. Some business sociologists have published some very interesting inquiries and studies that examine how firms think about purchasing health insurance. And the short of it is, among other things, very little attention is paid to the cost sensitivities of their lower and middle income employees. Lower and middle income employees are much more cost sensitive, but to the large degree, they are paying the exact same amount out of pocket. That is in terms of lost wages for their insurance as higher income employees are. So what Professor Herzlinger and I recommend is that instead of individual employees accepting the offers that their HR department offers, we encourage through the use of either actual ICRAs or through similar devices, that we make sure that individual employees have access to exchanges where lots of different insurance plans are available. And by the way, this doesn't have to be the public exchanges. These could be private exchanges. You can imagine a private exchange that's organized by not just one employer, but multiple employers, where lots of different insurance products are offered on this private exchange. Private exchanges, this I think is a favorite research topic of Tom's. They haven't really taken off, but to the degree that we can combine the opportunity to encourage individual employees to purchase their own plan with the availability of public exchanges, and frankly, the need for public exchanges to have more volume to stabilize prices and to stabilize the stability of choice, we could have a real marriage here. So if in fact you have employers offering individuals ICRAs, this is employer dollars instead of paid to a third-party administrator or paid directly to an insurer for a group plan, they are given directly to individuals with which the individuals can purchase insurances and pay for insurance premiums, but then the individual employees can pick whatever they want. And this is exactly the kind of surge of not only numbers, but also cost-sensitive individuals that the individual market really needs. One great quote from Peter's talk is, a strong individual market should deliver more choices. And if in fact you have a significant portion of the 105 million workers who currently are receiving employer-sponsored insurance and you put them into the individual market, you'll see a much healthier individual market. But our argument is that, yes, it's true, it'll create a better individual market, but it also will really allow individuals to purchase plans that are more appropriate for themselves. It will inject not just an individual market, but market-wide, it will inject a very significant surge of consumer demand, of cost-sensitive demand. Of course, one of the great problems with employer-sponsored insurance is that nobody knows how much they're paying. They don't see the full premium. They don't know how much lost wages they have. Well, this will bring those prices out into the open. One other nice thing about this marriage between employer-sponsored insurance and the public exchanges is that we actually think that a lot of the protections that public exchanges already have will be really useful. It's important to have navigators. It's important to only make sure that all insurance plans are ACA compatible, that they have adequate, consistent actuarial assessments, that they have all the consumer protections that ACA compliant plans have. That really would enable these exchanges, or whether the public or private exchanges, that would really enable individuals to comfortably go in to a marketplace and be able to make decisions on their own. The other nice thing about this, by the way, is that we propose, and this would require a little bit of rulemaking, we propose that if individuals are able to purchase health plans at prices that are less than the amount their employer contributes to their ICRA, then they get to keep that in tax dollars. Basically, individuals will be able to choose between non-tax premium dollars and tax take-home pay. And I think that would be especially useful, especially valuable to lower and middle income families. The last thing I'll say is that if we were to make this work, and this is more in the line of policy proposal, if we were to make this work, we do need some regulatory changes, maybe some statutory changes, although the lawyer, my lawyer friends haven't yet come up with an agreement on whether we need to have an act of Congress. We need to make sure that ICRAs and the individual market is available to individuals that are now getting employer-sponsored insurance in self-insured plans. Now, there are lots of reasons that large firms prefer self-insured plans over fully insured plans. But one feature of the assumption of risk that self-insured firms, the firms that choose self-insured plans have, one feature of having that risk is that they have to make sure that individuals are protected if they basically purchase plans that do not cover all their full cost of care. That's not something that you worry about in the fully insured market. In the self-insured market, firms are always worried about their expensive employees. So in order to achieve the efficiencies of a self-insured plan, but also allow individuals to select their own insurance, we propose what I think is best described as an accounting strategy, where firms would give individuals not the full cost of their insurance, but the full cost of insurance minus what we call a holdback. And we can calculate this. We can calculate this basically based on the difference between the individual price of a fully insured plan and the individual price of a self-insured plan. The self-insured plan basically does not include what the employer keeps to pay for the expensive individuals. It's basically an internally organized reinsurance plan. So it means that trying to translate the self-insured market into the individual market requires some accounting translations. There is something that requires basically an accounting translator. And we can do that. We can do that through some rules. It might require some additional statutes, but it's all doable. And it, I think, is necessary if we're really going to unleash the benefits of individual demands and cost sensitivities and diversity of preferences in the employer insured market, with the kinds of potential but current inadequacies or current instabilities of the individual market. So that's our proposal. We have more details that have been written elsewhere. But I think the main two contributions, the main two meta ideas that I want to emphasize is that, number one, the employer-sponsored market and the individual market are two sides of the same coin, although I guess maybe or two sides of the same dog, with one being the dog and the other being the body and the other being the tail. And secondly, making sure insurance markets work as far as affordability and coverage and stability is important. But what we really want to make sure is that insurance markets also bring efficiencies to the overall market and start solving the cost conundrum.
All right, thank you, Barack. We'll have to check on whether there's any seniorage involved in the two sides of that coin, with someone else scraping a little bit off the edges. But our next speaker, with a different perspective, as there are many coins involved in this auction, is Stan Dorn. Stan's director of the National Center for Coverage Innovation at Families USSA, with a special attention has been throughout his career to making coverage more affordable and increasing enrollment and retention across the insurance market. Before being at Families USA, Stan was senior fellow at the Urban Institute's Health Policy Center, attorney at the Children's Defense Fund, or actually the National Health Law Program, also involved with the Children's Defense Fund. And I first met Stan when he was a senior policy analyst at the Economic and Social Research Institute. Stan, take it away.
Thank you so much, Tom. It's a real pleasure to be with you and with these amazing, distinguished panelists. I'm going to talk about something much narrower than the visions we've just heard. The story that I'd like to tell begins in 2017, and I'm going to begin with a sort of a point of personal privilege. We went to court to try to stop Donald Trump's effort to strip cost-sharing reductions away from the individual market. We were amici. The California Attorney General's office had brought the litigation. I stayed up all night writing our amicus brief, even though, you know, my creaky old body doesn't like to do all-nighters anymore, but it was necessary because Donald Trump was going to destroy the world, and we had to stop that. And we were very optimistic. The judge, as Barack, a fellow inactive JD, can, at least I assume you're inactive, Barack can tell you there's nothing more important in litigation than the identity of the judge. And in this case, the judge was phenomenal. The guy was the former head of the San Francisco Health Plan, and he surely would understand the horrors that Donald Trump was about to unleash on the individual market. We were sure of victory, and we were wrong. We lost the case. I was shocked that a great judge like that could make such a horrible mistake. I read his opinion, and he said, you know, I went online and I looked at what happened to premiums after Donald Trump defunded cost-sharing reductions, and it looks to me like a lot of people are going to be better off. How could this be? As the months rolled by, we realized the judge was right, that what we had thought of as an attempt to sabotage the individual market had actually strengthened it, put more money into it, made it more affordable for consumers, made it more profitable for insurers. How could this possibly be? This relatively narrow, strange story is going to be the focus of my remarks in the next couple of minutes. Let's see if this works here. There we go. Can you all see my screen? All right, here we are. We are going to, so in the next couple of minutes, I'm going to tell you this strange story, which begins with the question of why was the judge right and the rest of us wrong? Not everybody was wrong. In fact, a lot of people knew what was going to happen, but not us. So here's what happened. In order to understand the impact of defunding federal cost-sharing reduction payments, CSR payments, we have to begin by saying, what the heck is a CSR? And as my talk proceeds, there will be fewer and fewer words and more acronyms. So, you know, fasten your seatbelts, bear with me. What the cost-sharing reduction statute says inside the ACA is that if you're an insurance company and you're offering individual market coverage at the silver tier, which generally is a 70% actuarial value plan, actuarial value means the percentage of claims that are paid by the insurer for a standardized population. If somebody enrolls in a silver plan and they're a low-income person, you don't give them just 70% AV coverage. You raise the actuarial value. You lower the deductibles and the cost sharing. They're low-income people. To access care, you need to have lower cost sharing. So the increase in the actuarial value gets very large for people under 200% of the poverty level. Instead of 70% actuarial value, it rises to more like 90% actuarial value. Now, the increased costs that result from this much more generous coverage were originally paid by Uncle Sam in these federal CSR payments. Once they went away, insurance companies were still legally obliged to provide this coverage, but how could they pay for it? Well, the actuarial answer, I'm told, is very straightforward. Premiums are supposed to be based on the cost of the claims that the premiums cover. Only silver exchange plans provide CSR coverage, cost-sharing reduction coverage. So the logical answer was pay for these costs through increased silver premiums. And when you do that, what happens is the premium tax credit amounts go up. Premium tax credits are based on the benchmark silver plan, the second lowest cost silver plan, minus the individual's income-based payment, which is defined in statute and implemented through regulations. So if the benchmark premium goes up, the premium tax credit amount goes up. This is a key feature of the ACA's design that Peter pointed out. So this means the judge was right. So let's take the story of Fred, an imaginary person, and he's offered imaginary coverage at $100 per month. Really, coverage tends to be much more expensive than this, but this is for hypothetical purposes only. He's offered benchmark coverage at $100 a month. His income-based payment amount is $50. That means his premium tax credit covers the rest, $50 premium tax credits. Now, in Fred's neighborhood, there are other plans available at other metal levels. A bronze plan, much less generous, 60% actuarial value, has a $75 premium. The gold plan that's available to him, an 80% actuarial value, has a $125 premium. Regardless of which plan Fred picks, he gets a $50, I'm so sorry about the noise in the background. The $50 premium tax credit. And what that means is if Fred picks the more generous plan, he pays more in premiums. He picks the less generous plan, he pays less. If he buys bronze, he pays 25 bucks instead of 50. If he buys gold, he pays 75 instead of 50. And this was an important feature of the ACA that was borrowed from some proposals made by the Heritage Foundation, among others. So that's what happened before CSR was defunded. What happened after? Well, silver premiums in the exchange went up, and this is an oversimplified account, but gives you the big picture. But the other metal level premiums didn't change. So what does that mean? Well, Fred's income-based amount is still $50, but the premium tax credit goes up to $70 because the silver benchmark plan has gone up to $120. That $70 premium tax credit is available regardless of which plan Fred picks. Therefore, if he buys the bronze plan, it now costs him $5 rather than $25. If he buys the gold plan, it now costs him $55 instead of $75. In other words, because Donald Trump defunded federal CSRs and silver premiums went up as a result, premium tax credit amounts went up. If Fred's in silver, the cost is unchanged. If Fred's in a different metal level, his costs go down. So in fact, more federal money went to subsidize coverage for low and moderate income people as a result of this change. And the impact was remarkable. I mean, Peter's, talked about the impact on the federal budget, but it meant more financial support for consumers and markets, more affordable options for a lot of people. Despite the Trump administration's substantial defunding of public education and application assistance, there was increased enrollment that resulted from more affordable coverage. It changed from less subsidized to more subsidized. There were much higher profit margins for insurers, and companies that had left the individual market after AC enactment returned to the market. It was much, much healthier. Who on earth could have imagined that this might happen? Certainly not us. So that is just the beginning of our story here. That's a tale that I think many of you know, but there's a mystery that I became aware of a few years ago that I'd like to share with you. I've spent much of the last couple of years trying to figure this out. I learned about this mystery from two brilliant actuaries in California, Greg Fan and Daniel Cruz, who wrote an article called Fields of Gold, and they spotted an issue that had completely evaded my notice. And I don't know that it's widely understood to this day, which is an incredible misalignment between coverage generosity and premiums in the individual market. So what the heck is this about? Well, how generous is individual silver coverage in the individual market right now? If you look at healthcare.gov plans, the plans that are run by the federal government for which more data are available, most people in these silver tier plans are now below 200% of poverty, which means that their actuarial value is roughly 90%. If you do a weighted average of all silver enrollees, it turns out that actuarial value is 89%. If premiums are proportionate to coverage value, which is what they're supposed to be, that means that silver premiums should be 11% above gold. Instead, premiums are 8% below gold. Silver should be more expensive than gold, but it's less expensive than gold. Now, this is not just an actuarial curiosity. This has a huge impact on people. We did a very rough analysis earlier this year of the impact in 2020 of this premium misalignment. And it turns out to raise costs for 97% of exchange consumers. Altogether, consumers pay $6 billion extra because of this premium misalignment. The biggest savings are enjoyed by people between 200 and 400% of poverty, but there are enormous savings for unsubsidized folks above 400% of poverty. But the question is, why is this happening? Why is there this radical misalignment between premiums and coverage value? This is a mystery. Now, if you want to try to figure out a mystery, or you want to try to indeed answer many of life's questions, we all know the place to go. You have to look to old black and white movies. And we know from the Sherlock Holmes adventures, there are 3 keys to unlocking any mystery: motive, means, and opportunity. So join me as we investigate this crime of misaligned premiums. What is the motive? Well, there's an obvious motive here, which is maximizing market share. The bulk of individual market enrollees are subsidized people, many of them low-income people, who tend to pick silver because that's where the CSRs are. That's where they get better value for their coverage. And low-income purchasers are extremely price sensitive. As we just saw, if you pick a cheaper plan, you pay less. If you pick a more expensive plan, you pay more. A few dollars can mean a radical shift in market share for low-income folks. Whichever company wins the pole position as offering the lowest price silver gains an enormous harvest in market share. So that is sort of an obvious incentive that plans have to aggressively underprice silver and make up for it in higher premiums at other levels. But there's another motive, perhaps a more insidious motive. Now, it's not really more insidious, but I want to, play into this murder mystery theme here, which is that some customers are more profitable than others. This is an analysis. This is a public presentation done by a major actuarial firm based on 2014 data. And what they found was that these low-income folks in CSR plans are more profitable than other people, way more profitable. This table here compares costs with risk level. Risk level determines determines risk adjustment payments. Like an insurance company gets money from premiums, but also there's these risk transfer payments, so that if you have a lot of sick people in your plan, foreseeably high cost people, you get money from risk adjustment. If you have unusually healthy people, people with low foreseeable costs, you pay into risk adjustment. And so when you look at the costs, at the money that an insurance company gets, premium plus or minus risk adjustment, it turns out that you come out 25 to 34% ahead with CSR people, low-income CSR people, and you come out 25% behind with gold people. Now, these numbers are different today than they were in 2014, but very early on, it was clear that something was amiss. Some people, based just on the plans in which they choose, are way more profitable than others. The same actuarial firm put this slide up, and you can see CSRs are the key to success. It's a very complicated graph. I don't really understand it, but I think what this is saying is over on the right-hand side, those are the people who make you money. Over on the left-hand side, those are the people who lose you money. The green bars are CSR people in silver. The blue are non-CSR people in silver, and the red are everybody else. And so what that means is if you want to make money, you get a bunch of those CSR people. They make you money. If you want to lose money, get those non-silver people. So the motive here is profit. Profit is how the market runs. And the whole vision of the ACA, one of the key visions, was instead of insurance companies competing by recruiting favorable risks and avoiding unfavorable risks, let's have them compete by offering good products at reasonable prices, which is what a market is supposed to do. But because of this imbalance in risk adjustment payments that overpays in silver, and therefore because risk adjustment is zero sum, overcharges in other metal levels, it means that silver people, especially CSR silver people, make much more money for insurance companies and other folks don't. And so that gives an incentive for insurance companies to aggressively underprice silver, raise prices at other metal levels, and that way they get the people who make the money and they don't get the people who don't make the money. Now, why on earth is this happening? Well, when CSIO created its risk adjustment scheme to start in 2014, there was no exchange. They had to look at large group coverage as the basis for determining risk adjustment. And so they said, well, okay, what happens when people are in high AV plans? How does that affect utilization? Well, they said in the large group market, let's look at companies where they offer 90% AV coverage. Turns out that those folks use a lot more services. Well, those folks are relatively affluent people employed by companies that offer generous plans. In the individual market, the folks enrolled in high AV silver are all by definition low-income people. And if you strip out morbidity, utilization is much, much lower. That is not taken into account in premiums. That is not taken into account into risk adjustment. And that means plans are getting overpaid for silver and underpaid for everything else, which is a big part of the motive for the crime of premium misalignment that we see. Now, what about means? Well, in order to understand means, we have to delve into another wonky detail of insurance markets under the ACA, which is the single risk pool requirement. And as stated in instructions to pricing actuaries, this means that when you are pricing an individual plan, you're an insurance company, you're offering, okay, here's my product, here's my HMO happy plan, I'm offering it in bronze, silver, gold, here's my PPO, even happier plan, I'm offering at every metal level. Each individual plan, you can't look at the claims experience of people in that plan when you're pricing the plan. You have to say, if my entire individual market was enrolled in this plan, the average demographic characteristics of the whole market in my company, what would utilization be? And the reasons for this statute and the accompanying regulation were described by CMS when they had their initial proposed rule, which was without it, you will have insurance companies evade the point of the ACA of having community, have modified community rating. Insurance companies will put some costly people into some pools, less costly people into other pools. Premiums will rise for the plans that serve sicker people, fall for those that serve healthier people, and that will defeat the whole purpose of the ACA. So this is a fundamental, though often missed central tentpole of the ACA structure. And plans are not following this when it comes to CSR enrollees. Not all plans, but a heck of a lot of them. So here's an example from an approved rate filing in California where they said, well, when it comes to CSR folks, yeah, we know that, they're supposed to be using more than gold because the actuarial value is higher, but my gosh, these are low-income people and their sensitivity to cost sharing varies. So based on the claims experience in this particular plan, we are lowering this plan's premium. That is not the single risk pool. That is experience rating snuck in through the actuarial backdoor. There's another example from a rate filing approved in Maine. They said, yeah, well, we know this is a little different, but here's the thing. Actual experience by meta level says that silver costs are lower. Well, we know why that is, friends, and we know it's because they tend to be lower income people. All else equal, they lose fewer services. But that again is experience rating. That is the means that insurance companies have used to pursue these understandable motives. What about the opportunity? Well, the opportunity is provided by state insurance regulators who have been treating CSR folks as this unique animal, not subject to the single risk pool requirement. Now, why is this? Well, it's totally understandable, a matter of sort of crisis response hardening into inflexible policy. So the crisis. Federal CSR payments were eliminated, as we talked about. Those payments are based on the actual claims incurred by CSR people. Uncle Sam paid the insurance company based on what the extra claims were for folks who were below 200% of poverty. When President Trump eliminated CSR payments, insurance regulators wanted to protect their markets. And they said, okay, guys, we know you're not getting money from Uncle Sam anymore. Raise your silver premiums to compensate for the loss of those federal CSR payments. Makes sense as a crisis response, but implicitly, you're ending the application of the single risk pool requirement when it comes to silver, because you're saying to make up for these missing federal CSR payments premised on the experience of people under 200% of poverty, you should raise your silver premiums to reflect that experience, not the overall risk pool in the individual market. So here's what we saw from California's insurance regulator in 2017. They said, okay, guys, if this goes away, if Trump ends the CSR payments, y'all can raise your revenue enough to cover the actual cost of providing silver plans, experience rating, not the single risk pool requirement. Washington's insurance regulator in 2021 shows how this crisis response has hardened into entrenched practice. They told insurance companies, with everybody else, price based on the single risk pool. But when it comes to CSR people, price based on the unique utilization of the subsidized populations. Understandable that this was the crisis response, but it no longer comports with the law. Now, how does this tale of greed and short-sightedness end? Well, we hope it doesn't end the way it ended in this black and white movie from a few years ago with miscreants being sent up the river. Rather, we hope, at least those of us, I hope, it ends like this. Number one, CSIO, hopefully, the Center for Medicare, Center for Consumer Information and Insurance Oversight, will reduce the motive for bad behavior by fixing risk adjustment so that it compensates for the actual cost patterns of people in high AV silver rather than the utilization patterns of affluent corporate employees. Second, it's time for the sheriff to start enforcing the law and make sure that insurance companies have to price, when it comes to CSR people, the same way they do for everybody else based on the single risk pool requirement. And notice, this could help insurance companies, not just consumers. Why? If every insurance company followed the law, then there would be some gains for all insurers, not necessarily guaranteed, but there would be gains. And that's been borne out in practice by states that have cracked down on this, where you get more customers because insurance is more affordable. Customers migrate from high deductible plans to lower deductible gold plans. They like that better. They stay in the market longer, which is a huge boon to insurers. It costs you a heck of a lot more to get a new person than to keep an old person. But there's a prisoner's dilemma. If you're in a competitive market and you know your competitor can break the law, and that means that if you follow the law, you're going to get killed financially. The only way insurance companies can do the right thing is to have the regulator be the cop on the beat and make sure that nobody can do the wrong thing. So by fixing the motive, by closing the opportunity and ending the means, we hope that there will be an ending that is happy for consumers and for insurance companies. though maybe not for federal taxpayers.
All right, thank you very much, Stan. I may have to risk adjust your remarks because we've blown past our normal time limits. So we're going to have to bypass the intra-panel discussion and move to our second. Probably the moderators spoke too long at the start, must be the entire cause of this. But in any case, we're going to move on to our two discussants who will, there's plenty of, there's lots of targets on the board in terms of what the numbers mean and what they don't mean. And that will be our next two speakers on panel two, Dave Anderson and Seth Chandler. And I will introduce them and we'll try to see if we have any room at the back end for some Q&A, but we're running a little tight on this one. So to start things out, Dave Anderson well, he handles everything in terms of health insurance as a bit of a specialist and knows what's going on in markets at the Duke Margolis Center for Healthcare Policy. Many people say to me, why are all these Duke people on? And I explain that, you know, Duke validates my parking when I go there to teach a class once a week. And, you know, it's just economic incentives on this front as well as quality people. But Dave also has commented for a number of years prolifically on the balloonjuice.com blog, widely quoted in this field. Has degrees at Carnegie Mellon, and now he's back pursuing a doctorate at Duke as well. But given our short time, let's go right to Dave for what he makes of what is actually going on in the individual marketplace and surrounding environment. Dave, are you set to go?
Yes, I am. Thank you, Tom.
Oh,
Thank you, Seth, Barack, and Peter. This was a lot to think about. I need to say first, because you gave us a lot to think about today. So disclose, now all thoughts of mine and mine alone, speak for no one else. And I've received some funding from National Institute of Healthcare Management for some stuff I may discuss later on. So there's two things we really need to think about. Now, two important points. We need to manage risk and we need to manage our outliers, manage the choices. Both Peter leaning on the idea of consumer as chooser and then the choice as a means to discipline the market, which means we need high quality choices. Stan really discussed about managing risk and outliers, as did Peter. So risk adjustment is critical. Now, risk adjustment is how we keep the market from racing to the bottom and eliminating benefits that are attractive to high cost, high risk individuals. But it's imperfect. Good risk adjustment is pretty good for people up to about the 90th percentile claims distribution. The last 10% is where we have significant challenges. Now, some of that 10% is acute injuries, COVID event time in the ICU due to COVID, car crashes, unexpected high-risk pregnancies, and some is very consistent recurring cost with known but unusual high impact. Hemophilia is going to be a very common example. One, rare and orphan disease is going to be another area where it can be very high cost that's poorly risk adjusted. And these costs can be very predictable. So we need to think about our outliers. A couple years ago, there was a kerfluffle in the individual health insurance marketplace discussion sphere about a individual in Iowa who was costing over $1 million a month to insure. This individual had a complex expression of hemophilia that was recurring and expensive to treat. Iowa in 2008, single insurer state, and that is a stable solution for when there are high residual net of risk adjustment and net of reinsurance cost. A single insurer can incorporate all expected cost into the premium, charge premium, and collect enough claims. When there's competitive markets and high residual cost, whoever gets the known residual, get the people with the known high residual cost, they're losing a lot of money or they're raising premiums and they're losing all their healthy enrollment. So this is where Peter brings up a very good point about the value of reinsurance. Reinsurance to cover known high cost individuals works. It brings it out. Now, it brings those costs, allows the market to be more functional. But the problem is, the ACA reinsurance system doesn't really work under that concept. Instead, it's being used as a means to reduce average statewide premium, gross premium. Gross premium is what individuals who are not subsidized pay. That's primarily individuals who earn over 400% of federal poverty level, older, larger family groups, whiter than average. These are folks who have significant political pull. So when they're in pain, they can scream, and when they scream, they can be listened to. So the state reinsurance waivers, on the whole, have done a pretty good job of reducing gross premium. Doesn't do a whole lot to change net premium. If anything, it slightly increases net premium for subsidized individuals. But that's another discussion for another day, because I can talk about that all week. Now, there was a recent paper by Holkover, Biniak, and Bundorf in JAMA Health Forums that makes this point very clear. Reinsurance, as implemented in the ACA by the states, does not do a good job of reducing risk variation. Now, as Peter mentioned, Minnesota has a program where they take on for a caliber, between a floor of, I believe, $50,000 and a ceiling of $500,000. A $50,000 claim is an unusual claim, but it's not a fundamentally bizarre claim. That is an individual who has pediatric cancer, metastatic cancer. That is an individual who might be on, a Hep C antiviral for a year. Now, those are unusual, but not utterly bizarre. So now, as we can see, Minnesota's efficacy in reducing variation isn't that high compared to the possibility frontier. And this design is pretty common. Alaska and Maine do something a little bit different, where they take on specific conditions and pull out those costs from the marketplace and low premiums that way. But these mechanisms don't reduce variation of risk all that much. So, the one thing that not in the, which they had discussed a little bit more, is there is a catastrophic reinsurance program run by CMS, where each insurer, through the risk adjustment program, where each insurer is charged, I believe, 25 cents per member per month to cover some of the cost of claims of above $1 million. $1 million is a truly unusual outlier claim. These are the claims which a statewide market like California or New York or Texas or Florida, they're big enough where they can eat the risk. But a small market such as Iowa or Delaware, they can't eat the risk. At that point, you have situations where the stable solution is a single insurer operating the entire state. And we know that competition, or we strongly assume that competition is good. It provides more choices for individuals, provides lower premiums, and provides some discipline to the market. So national reinsurance that truly focuses on true outliers is probably a highly effective and efficient way to lower actuarial risk and lower premiums. But we really don't do that right now. The next thing I want to talk about is the ACA's choice-based challenges. Now, this is where my research is moving towards, and we assume that choice disciplines the market. Choice is a way to move forward, and choice is a way to get what we want through the aggregation of preferences. Now, I just want to pull up two things. One is from a friend of a friend on Facebook. Amy is a very intelligent person. She does not think about health insurance 40 hours a week, unlike me. So when she put this up on Facebook, I could share and say that my research actually had real world applications to the folks I used to drink beers with. She raised a very good question. Why is gold cheaper than silver? This is everything that Stan was talking about. Now, gold's a great deal for, if you like Highmark, gold's a great deal. However, it's confusing. She got stuck trying to figure out why this was happening in catch. There was some good research by Peter Ubel in 2015 where the bronze could be seen as either the cheaper plan or the high AV plan. This is not intuitive. On the right-hand side is some research I've done with Doctors Petra Rasmussen of Rand and Coleman Drake of the University of Pittsburgh, published in JAMA Health Forum in July. And with the introduction of the American Rescue Plan subsidies and automatic re-enrollment, hundreds of thousands of people could be placed in plans strictly dominated, which means the plans they're placed in, there's another plan that is both cheaper, it's from the same insurer on the same network. And this is expensive. This is several $100s a year premium and several $1,000s of extra deductible. Now, markets where there are dominated plans are inefficient markets. So in these markets, there's a lot of choice. Again, some research I've done with Patrick O'Mahan of Baylor. Over 75% of the people on healthcare.gov in 2021 had more than 25 choices. Almost half had more than 50 choices in 2021. Next week or two, we'll see the public use files for 2022, and I'll be shocked if this has not increased. We know that people have a lot of choices to make, and these choices are good if they're clear choices where there's easy differentiation of key attributes. But once we get 25 or 50 choices, as we've seen in Medicare Advantage, choice quality crashes. So as we think about this, as we go into the paradigm, of consumer discipline, there's a strong assumption that the choice space is understandable and clear. And these are big challenges. So let me pass this off to Seth for his part, for introductory remarks.
Thank you very much, Dave. We are accelerating a little bit. Seth Chandler is Law Foundation Professor of Law at the University of Houston Health Center, specializes not only in insurance law, but applies math and computer science to law. So Seth knows how to count, unlike many other theoreticians in this field, and that's why some of his analysis counts for a little bit more impact. And he's widespread in terms of setting up a couple of different unique blogs in this area. But because of our accelerated time, you can read more about his bio. Seth, go right ahead with your comments.
Great. Well, thank you so much for inviting me to speak on this. So one of the things that are interesting is that none of the speakers here are really directly challenging the ACA framework. I'm not hearing cries for Medicare for all or repeal and replace. And instead, it's a pretty wonky technocratic improvement talk, which is partly because that's what the AEI asked for, but it's also a very good thing. And so I think we have to realize that the ACA is the world we're living in for the foreseeable future. And so we might as well make it better rather than worse. I'll note that there are some sort of subtle attacks on some premises of the ACA. From the right, we have a call for decoupling employment and insurance via HSA expansion. And from the left, we have a call, at least in some of the materials, although less so in the talks, to make ACA benefits so generous that they basically approximate universal coverage. So let me go through things I like in the talks, things that are in the middle, and a few things, at least in the documents, that I didn't care for so much. To me, this is the most important graphic that we really need to think about, which is, that's a very troubling number. To say that it's costing $21,000 per marginal person to get people into the ACA. So I think people who love the ACA need to say whether this troubles them or whether it's fine to be spending $21,000 per marginal person. If this figure's wrong, then we also need to know, why is this figure wrong? Where's the math gone wrong? And one possibility is that we may be looking at, in part, an apples to Ubri-King melon critique. Ubri-King melon is apparently the most expensive fruit in the world. And that is that when they're shifting from old style plans to new ACA plans, they may well be getting better plans. And so it's a little unfair, perhaps, to just look at new enrollment gain as the denominator in this computation. And also, some of the payments may be rents. They may be transfer payments to people who are poor. We could debate whether that's a good thing or a bad thing, but they may not be just rents. But nonetheless, very important graphic, really need to think about it. Other things I like. HSA expansion. I think that's a very appealing idea. It leads to greater freedom, and it accomplishes, as I suggested here, it's kind of a stealth way of decoupling the labor market from the health insurance market, and permits people to trade maybe some health insurance for taxable under this plan wages. Plus, it would stimulate maybe multi-year plans, which I think is a good thing because it can stimulate wellness. One thing we ought to think about is it's a little similar perhaps to the free choice vouchers that were part of the original ACA, which were actually repealed shortly after the ACA was enacted. And there was some fear of adverse selection resulting from offering those kind of choices. We ought to be a little concerned about that. The other is a paternalism worry that if people start choosing really cruddy health plans in order to get taxable wages, we're going to have the problem of uninsured and underinsured people. The other concern is a little bit of a political worry, which is that the last major effort to decouple the health insurance market from the employment market was the Cadillac tax, and that didn't do so well, although maybe that's because it had the word tax in it, whereas this method does not have the word tax in it, and in fact, it's not a tax. What else do I agree with? I agree that reinsurance doesn't really make much sense in a world in which the American Rescue premiums would continue. That is, the main purpose of those reinsurance waivers was to provide some relief for people who were really hurt by the Affordable Care Act's cliff effect of cutting off all subsidies at 400% of FPL. And so reinsurance, by lowering premiums across the board, did provide some opportunity. But why would we want to continue with that method of providing a subsidy? Why not do it directly to people and set the degree of progressivity however else we want them? Moreover, we're not in the beginning of the ACA now. Why do we need for the government to be providing reinsurance? If insurers want reinsurance because of some of the risks that Mr. Anderson, Professor Anderson pointed out, they may be able to get that in the commercial market, and I'm not sold on the need for the government to be providing reinsurance. As far as reinsurance current plans being inefficient, I wholly agree. And any economist would tell you that you don't reinsure risks in the middle. You reinsure the tail risks. And the only reason to maybe have some reinsurance in the middle is to deal with moral hazard by insurers who aren't going to control costs otherwise. But again, real reinsurers balance that moral hazard against the desires for more complete risk transfer all the time. And it's another reason that I'm very skeptical about whether government should be providing reinsurance. If insurers need reinsurance, then go get it. As far as calibrating subsidies with the second lowest silver plan premium, or using instead, as Professor Richmond suggested, a premium invariant subsidy, I have some sympathy for this. That is, a second lowest silver plan, first of all, it leads to the potential for manipulation in markets where there are only two insurers. That is, if the second insurer drives up their premium, even though no one buys the policy, it's still listed as the second lowest premium, and it creates greater subsidies for all involved. And so I'm a little worried, and I would love to see some empirical work done on whether there are these phantom silver policies that nobody buys that nonetheless drives up prices. The question I have about these premium invariant subsidies is, we're told that it will compensate for geography and age, and I do believe that. I have some question as to whether we should have full geography-based subsidization. Why shouldn't the cost of medicine be a factor in people's location decisions? I believe it would control spending better. The question I have is, given the arguable lack of responsiveness in Congress these days, would we really be able to have Congress develop a good formula for figuring out what the baseline premium should be? I don't know whether we could have annual adjustments in those numbers to take account of real changes. So I like the idea of getting away from the second lowest silver plan, because I think it does lead to manipulation. I do have some concerns about the moral hazard problems there. I need to see a little more concrete solution before I'm sold. The silver mystery. What this tells us is that wonky details matter. And it shows again the crucial importance of risk adjustment to the operations of the ACA. I think it's interesting that there's actually now some unity between concerns of people like Brian Blaze, who worked in the Trump administration, who were on the right, and people who I think are sort of on the left, like Stan Dorn, about how risk operation is actually working. I've had concerns for many years that risk adjustment leads to market concentration, because a small insurer now not only has to figure out what the risk of their own pool is, they've got to try and figure out what the risk and how risk adjustment works for other insurers. And while a big insurer might be able to absorb some funky things in risk adjustment, I have real question as to whether a small insurer can do so. And in my opinion, there's a likelihood that risk adjustment has led to the increase in market concentration in health insurance that we've seen since the ACA. An interesting test of whether the theory that Stan Dorn was advancing is whether what he describes as this underpricing of silver plans would persist in states where there's only one insurer and thus there is no risk adjustment. And in the chat, he was telling me actually there is some evidence that it's less of a phenomenon in those states where there is really only one insurer. You know, the one question I have is it so bad if insurers are charging people less for silver plans than they really should? I agree that weird pricing is generally not a good thing, but on my scale of evils, the fact that people are being charged less does not rank all that high. I did note in the materials there's some stuff I didn't like from Family USA on elimination of budget neutrality in 1332 waivers, insistence on various constraints, limitations on debt collection mechanisms, longer open enrollment, all of those. The problem is that increases still further the cost of the Affordable Care Act in an era where we are running monstrous deficits that are already destabilizing markets, and in my fear, will continue to destabilize markets as we move forward. So what we've got is the ACA is serving as a placeholder, I think. There's no real appetite among most Democrats for Medicare for all. They may say so, but here there was $3.5 trillion to spend and really no talk about Medicare for all. I don't think there's really an appetite among most of the most realistic Republicans to repeal the ACA. Again, these are both great talking points to rile up the base, but when it comes to reality, we don't have that. And instead, what we're trying to do is to fix the kludge. That's the ACA. And we now have 10 years of experience, and I think that we can design systems that are more robust against risk adjustment, against phantom silver policies. And now that the individual market is working better, maybe I kind of agree. Let's make it work yet better by decreasing the sticks that force employers to provide health insurance and instead create a more robust individual market. And with that, I will stop.
Thank you very much, Stan. Just a little forecast warning. It looks like we're running out of time, and so we'll not be able to have Matt Damon as our final guest on tonight's Jimmy Kimmel show. But I'm going to bring back the earlier panelists. Seth has had a lot to say, and certainly the alchemy of trying to mine the tax code is always mysterious and takes different directions. I've noted there was some earlier work, I think, by Drake and Abraham on the exploiting of the silver loading in 2019 in a very good article in Monopoly Insurer Rates. And things have changed a lot from what happened in 2018 and 2019 in terms of the premium spikes, which aren't going on anymore, and the exploiting of the silver loading and pure silver loading. But that's water partly over the bridge. We've got more water to come. So what I'd like to do is for the three opening speakers, in sequence, if you have any burning rebuttal points, this is a one shot and off before we hit the exit doors. We'll go a little round table from Peter Nelson to Barack Richmond to Stan Dorn with just some final remarks like, no, you didn't understand what I was saying. It actually was much more brilliant than even appeared on the surface. Let's try that approach very quickly before we need to hit the exit doors. So Peter, go right ahead.
Yeah, I'll just briefly touch on reinsurance a little bit more, because I completely agree with David that the reinsurance programs as they're set up across the country right now are focused on reducing premiums. And the proposal I discussed was very much, again, focused on reducing premiums. But I do see a very good role for reinsurance possibly in making the risk adjustment program that CMS administers a better program. Risk adjustment is a central feature of any market that guarantees coverage to people regardless of their health status. And our risk adjustment program right now is imperfect, and it will always be imperfect, but we should always be looking to improve it. And so I very much appreciate what David said about adding possible risk reinsurance as a component. We could also think about adding a prospective risk adjustment as a component to the program. Right now, we look at the current year as on a concurrent basis to assess the risk of the people that are in the market, to assess what we think are the expenditures that should be happening in a certain health plan versus another health plan. And if we were to move to a prospective basis, we could possibly add some more information to this assessment. And we now have some of that information, which when we started the program, we didn't have the year prior information. And that's why we started with this concurrent program. We look at the specific year for risk adjustment. So add in prospective risk adjustment, add in reinsurance. It's all more information to help make a more perfect risk adjustment program, which really is a key part of the ACA and the guarantees of coverage for people with pre-existing conditions.
Thank you, Peter. Barak, your final thoughts on why we just didn't quite understand the brilliance of what you presented.
Well, I'll say there are two meta issues that I really have not been part of this discussion. I mean, number one is if in fact we manage to bring some of the some individuals who are currently under employer-sponsored insurance into the individual market, I'm very curious what that would do to all these actuarial analyses. I mean, even if you have 10% of the 100 million people who are currently getting employer-sponsored insurance, that doubles the individual market. And it does so with individuals who, these are by definition employed individuals. They probably do not require the same kind of, or would not require the same kind of CSR relief. So it would be a very different kind of an individual market. So one call for research is I would love to see what the actuaries would do if the prospect of that were to happen. The second is I really would love this largely actuarial conversation to intersect with the innovation economists, or basically you could say the innovation economists and the actuarial should really talk to each other. We're at a moment where I think the delivery system is at the cusp of potentially some really interesting changes with the rise of telemedicine, the rise of a hospital at home, maybe even with the rise of new kinds of consumer and digitally oriented insurers. And when the market is really different, when it's subject to a lot of innovation on both cost and quality, that makes the actuarial job a lot harder, but maybe a lot more interesting. I really think that health policy needs to be innovation focused, not just actuarial focused, and maybe that could be the next AEI event.
Well, the true innovation in health policy and even in the provider market is how to extract more money out of the taxpayer. And they're quite innovative in that regard. But we'll wrap up with Stan Dorn for some final remarks. Abbreviated, Stan.
So meta-wise, there are two key principles here. One is health insurance is complicated. And two, the individual market under the ACA is really weird. Health insurance in general is weird. If you pay more subsidies per person, the cost per person goes down. That's what CBO told us when I was at the Children's Defense Fund and we were structuring CHIP, because the more subsidies you provide, the more affordable it is to get coverage and healthier people sign up for coverage. That's why in Massachusetts, where they subsidize ACA premiums, they supplement those ACA premiums, they have some of the lowest individual market rates in the country, even though they have some of the highest provider payment rates in the country. Their risk level is low, the per capita costs are low. The other piece worth thinking about in terms of intervention in the market in Massachusetts under then Governor Romney, they aggressively intervened to encourage plans to offer smaller networks and take the Harvard Medical School out of the picture. And that was possible in the individual market, not in the large group market, because no company is going to be able to recruit workers if it doesn't say, yeah, you can go to the Harvard Medical School. But in the individual market, premiums are king. They offered plans that excluded Harvard Medical School, that lowered premiums. And because they merged the individual and small group market, employers have bought this low cost coverage as well. Coverage that began in the Medicaid program and now is dominating in private markets in Massachusetts. Now, there's no question, spending federal money is something that bothers a lot of people, but folks, healthcare costs a lot of money in America, and that's not going to change. The cost curve might go down, but it's expensive. And if you want insurance that covers your needs, that makes it affordable for you to go get the healthcare you need, that costs more money than people can afford without help from an employer, without help from the government. So you have to choose. We're not going to spend as much for people, and then people won't get the coverage they need in the individual market. And the long-term incentive to move towards Medicare for all will appear more inexorable. Or you can say, to make this market system work, we need to invest the federal resources that make it more affordable for people. 3 million people have signed up for insurance since the American Rescue Plan improvements went into effect. Coverage was more affordable, premiums fell by half, deductibles fell by 90%. So, you may not like to spend money, but and you don't always get what you pay for, but you never get more than what you pay for.
All right. Well, we have learned to our disappointing experience that it appears there's a broadening consensus that risk is too important to be handled by private insurers. The only risk takers we seem to have around who are willing or unwilling, unwitting, are taxpayers. But in any case, the writings of the various speakers in greater depth are posted on our event page, and you can find more where you look for in that front. In the meantime, drive home safely, or just park your feet up and have a pleasant time in virtual world. Thank you very much for joining us today. We appreciate it, and thank all our speakers. Have a good day.
Thanks, Tom.
Thank you all.
Thank you.